Retail declining, corporate profits declining, layoffs. The Atlanta Fed keeps revising GDP and it's going lower and lower. Manufacturing's declining, service sector's declining, but the stock market is up, and the president's out there telling us that everything is A-okay. I mean, what is going on right now?
Well, what's actually going on right this minute as we're recording this, there's an emergency meeting between the Fed officials and also the president. So we can imagine that everything's fine on the one hand, and that people are delusional if they're saying the economy is not fine, or something like that. But yes, there's clearly a lot of signs of economic weakness out there. I think there are signs of recession, and the stock market keeps powering higher. But let's examine again, why did it power higher? 2:00 in the morning, stock futures vaulted upwards, almost 20 S&P points laid on between 2 and 2:20 in the morning. And that's the typical pattern for manipulation in the equity futures market. It's a thinly traded market. Nobody of any import is open at 2 in the morning. And they try, you open up the newspaper like, oh, there was rumors of or talk of Italian bank bailouts. That's why suddenly 20 points got poured onto the U.S. stock market at 2 in the morning. But that's not really it. Eric Hunsader of Nanix has done a great forensic job digging through the stock future data and said, basically, if all you did was hold stock futures from 2 to 3 in the morning, you made out like a bandit over the last 5 years. That's when almost all of the gains in the U.S. Stock market can be accounted for. So inquiring minds would like to know, what's so special about 2:00 in the morning?
Yeah.
That's kind of an odd thing, right?
What about the high-frequency traders and the plunge protection team? How do they continually push the market up?
Well, David, it's an ecosystem of players at this point in time. I don't think the Fed has to step in and buy every single future out there. We have these high-frequency trading algorithms. They sniff around with millisecond precision, looking for any sign of liquidity out there. They've been trained, obviously. These are trend and pattern detection systems, so they know better than anybody listening the importance of 2:00 in the morning. And so I think that if somebody, plunge protection teams, Fed lackey, JP Morgan doing the heavy lifting, whoever it is, all they have to do is throw a little bit of money into that time period. And like a school of piranha attracted to some fresh chicken meat, you get all these high frequency trading algorithms out there just piling on. And so this ecosystem now, this is the most easily manipulated market in the world's history, because of the fact that it's not people anymore. You and I don't have any influence on this market. Human traders don't have any influence. It's all computers. All they care about is which direction are things going, and then they will follow along with that and apply their own magic sauce to this. So there's plenty of liquidity in the world marketplace. There's no shortage of money in the marketplace. That's what zero or even negative interest rates will do for you. There's plenty of money. The central banks have all said, don't worry, we're just going to keep as much money as necessary to keep the stock market elevated for as long as necessary. But you opened with the wrinkle in this story, which is we have highly elevated stock markets and we have crumbling economic data underneath. That is a very large gap that's opening up. And of course, the worry is that when those gaps close, they tend to close with a lot of potential energy. They tend to be fast, sudden, and they can create a lot of damage simply because there's just too much of a gap between reality and the fictitious markets that the central banks have given us.
So I wanted to talk about debt. The U.S. has quite a bit of debt. I mean, it's doubled since 2008, and the world debt has increased dramatically. Do they have this under control at all?
No, listen, 2008 was the warning shot across the bow, and that was the moment when the world should have looked around and said, hey, wait a minute. Maybe growing our debts at twice the rate, compounding at 8% per year, twice the rate of our underlying income, which was growing at maybe 3.5% per year, which is GDP, maybe that wasn't a good idea. And instead of saying that, we doubled down. The authorities, monetary fiscal authorities. And so what happened next was debts were just piled on. We went from, using very rough numbers here, about $150 trillion in debt before the economic crisis to well over $200 trillion of debt across the world. and much of that increase came from sovereign debt. And it's astonishing. Right now, the Italian banking system, which was rumored to be rescued or in the process of being rescued, is literally fully insolvent. And yet the 10-year debt of Italy is trading at less than the 10-year debt of the United States in terms of yield. So the price you have to pay for the valuable obligation and right to hold Italian debt, you have to pay a higher price than to hold U.S. debt. And Italy is an economic and financial basket case in the making, and a disaster that's going to come at some point. We know that. It's just math.
The European banks like Deutsche Bank, they're all crumbling apart. And you actually had an article on your Peak Prosperity website, Return of the Crisis. Suddenly banks everywhere are in deep, deep trouble. What do you see happening with the banks at this point?
Well, Dave, the banks have been playing a game of sort of just hide the cheese, right? So what they've been hiding on their balance sheets. By the way, if anybody wants to try this, I don't recommend it unless you have a lot of time and a high tolerance for pain. But just grab yourself one of the major financial statements from, say, J.P. Morgan. Their last 10K out of 260 pages, right? You can't decipher this thing. Teams of analysts don't know, because there on page 186, you might find a footnote that says, oh yeah, by the way, we're holding a lot of derivatives and we'll record them however we feel best, right? There's no way to analyze that and say, what are these things really worth? We don't know. So there were a lot of very interesting smoke signals, not the least of which was Deutsche Bank coughed up a huge portion of its credit default swap and interest swap derivative portfolio. I mean, hundreds of billions of dollars, trillions of dollars of notional value of these things were suddenly bought by U.S. banks, Citi and J.P. Morgan. And, it's just a little footnote. It's on Bloomberg. It's just one of those things like, oh, yeah, Deutsche Bank sold a whole bunch of derivatives off. And behind the scenes, we have to wonder why that is, because here's the thing about banks, Dave. They are not in the position of selling off winning positions. That's not something they do. So the question is, how much of a loss does Deutsche Bank have to take on those? But why would other banks in the United States be assuming what we can guess are losing positions? It just doesn't make a lot of sense unless you're thinking that the Federal Reserve is looking at a big derivative accident potentially and saying, gosh, we don't know how to directly bail out Deutsche Bank, but we do know how to directly bail out Citi if we need to, or something. There's so many cross currents going on here. We know that the banks have not been open and transparent about the garbage they've got on their balance sheets. And unlike Greenspan, who seemed to think that derivatives magically launched risk into outer space, never to be seen again, that's not how they work. Derivatives are zero-sum games. For every winner, there's a loser. Exactly, offsetting. So if you follow that, it's not hard to understand that if it's exactly offsetting, there's no possible way for the risk in that story to disappear. All they can manage to transfer is who took the loss off of that from party A to party B. You can distribute the loss a little bit, but you can't make the risk go away. And so when I look at the world's financial system, banking system, I see a system that has not cleansed the risk, honestly, in over a decade. It's stored it all up like potential energy, and there's going to be hell to pay when that risk actually has to be accounted for and priced in.
Now, in the beginning of our conversation, you said the Fed's having an emergency meeting. Obama is meeting with Janet Yellen. And we see that right now, Japan, Europe, they're all in negative interest rates. The Fed increased the interest rate here. And we're also hearing strange talks about the Fed or the central banks around the world distributing money to the people. I mean, should we be worried about that, where their answer is, let's print a lot more money and give it directly to the people?
Well, of course we should be worried about it. We know that, they're going to keep trying the negative interest rate thing, but it's pretty clear from the squawking noises that the big banks are making that negative interest rates are a bad idea. They destroy value. The idea of a negative interest rate was that you actually give a negative rate of interest to the large banks, so they have excess reserves on deposit or a deposit facility in the case of Europe. And if they're getting negative yield off of that, they're really not going to want to hold it. So the idea is, they'll go and they'll loan it. But if the corporations don't want to borrow it and the banks don't actually want to lend it, there's really no, all it does is destroy bank profitability. So that's a component of the overall financial or banking system weakness we're seeing, is they're just being destroyed by it. As well, the whole idea that if they then pass that negative rate on to consumers, that the consumers would then go out and spend it, thinking, oh my gosh, if I'm going to be losing money keeping my money at the bank, I'll just spend it. But perversely, it turns out that when people are getting just absolutely crushed and they're very uncertain about this stuff, they save more, they don't spend more. Go figure, right? So it was just psychologically, it's a disaster. So I think they're in the process of like, well, what's next? I don't think more deeply negative rates are really on the books. I mean, the United States might go there just to balance it out so that we're all on even footing when we go to part two, which is what you're talking about, which is, look, if low interest rates don't work and negative interest rates don't work and giving money to the big banks doesn't work, what's left on that tick list? Well, there's really giving money back to people, money for Main Street. We've seen the trial balloons floated for that in Europe, in the UK, in the United States. People have been talking about it. And so that will happen. And, of course, we're going to learn as humans again that you can't print your way to prosperity. They're going to try. But when they print this money up and hand it out, my advice to my subscribers and listeners is spend everything you can as fast as possible, because that's the final act in this play. That's you are down the road now where you're heading towards Venezuela, towards Zimbabwe, towards Weimar, towards wherever, where this has been tried before. There's a big advantage to whoever goes out and spends first, right? But again, why wait, right? So, accumulate gold and silver, make sure you have real assets right now. That's tangible things, land, good real estate, a nice, whatever you ordinarily spend money on, you might as well spend it now if you can and put it in your basement or whatever your strategy is. The last thing you want to be is the person who waits and waits and waits and then starts to spend. So when we get the money for Main Street thing, that's when I have my clarion call, which is like, go, have your buy list ready and just execute.
Now, you mentioned gold, and since December of 2015, gold was at like 1050. And now we see gold creeping up again. We're at like 12 and change at this point, almost $200 from December. What is happening now? Why is gold moving up at this point?
Well, the price of gold is still set in the U.S. futures market. Dave Fairtex, a poster and a contributor to my site, has run the numbers and proven to his very analytical trading mind that there's overt manipulation that's executed through the paper's futures market. No surprise to any of your listeners. But we know that for whatever reason, there's been a lot of heavy downward suppression. While that's been happening, I wrote a very detailed report about 6 months ago, just noting the flow of gold from the west to the east. And I had Jim Rickards on recently. I see you have as well, but he thinks that maybe this was a covert way to allow China to accumulate a bunch of monetary metal so that when there's a reset at some point, China's sort of on even footing, and that was a demand they might make. I don't know. It's possible. That's a speculative approach that could make sense, but unmistakable is that a huge amount of gold has been leaving London mostly and heading for India and China after routing through Switzerland for a little recasting into appropriate 1 kilobars. That we know that just adding the rough numbers, there's somewhere between 1 and 2,000 tons per year, in excess of world mine output, has been heading from west to east. And that's an extraordinary number. We've never seen gold flows like that. I can't for the life of me explain flat to declining gold prices in the context of that. So this little bump up from 1050, which was a really manipulated, heavy pounded low, back to 1250, remember we were at 1900 in 2011. So I still see us as largely being in a trading range. I don't see the panic that's come on yet, but I do believe that there will be a break in the market, a dislocation, and there will be a scramble. And anybody who's sort of waiting to top off their gold supplies or accumulate their first gold will be very disappointed by waiting. Because, supplies could become, at the retail level, very hard to come by.
Now, do you think gold will continually and gradually move up, or do you think we're going to see sharp increases when the time is right?
No, there'll be very sharp increases when the time is right. But again, this suppression game has been going on for as long as I've been following it, and I think that they will continue it for a while longer. So my belief is that the prices of almost everything at this point are manipulated for political benefit at this point. And I consider what the Fed is doing politics. Politics is the art of deception for the most part. It's managing perception to achieve policy outcomes. That's what our markets have become. This isn't just a couple of bloggers talking to each other. We're seeing statements like that coming from the head of equity strategy at major banks, or the poor currency people who, know that they're in a heavily manipulated market. And so as the central banks go out and manipulate and do everything they can to put lipstick on this pig, all we have to do is wander over to the real world, and we see that the kind of growth that would be rationalizing and justifying all of the central bank actions, all of those bank actions make sense if and only if we get back to rapid economic growth. Well, Japan has proven that once you surpass a certain debt load, rapid growth or even any growth economically is difficult to achieve. But what we also notice is that world competition for actual resources is a limiting factor on that. So right now, if world wanted to move to, say, 4 to 5% real growth, we would need an extra 2 to 3 million barrels per day of oil production, which I know oil is well supplied in the world market right now, but only by 1 million to 1.5 million barrels per day excess. We would suddenly find an oil price spike if we tried to move back into rapid growth. That price spike would run headlong into 200 trillion of debt, and the whole thing starts over again as a big crisis. So really everything the central banks are doing just doesn't make sense from a long-term perspective or even a common sense perspective at this point.
Do you think we're in a recession at this point?
Well, globally, it's harder to say. Certainly we've got bad ones raging right now. Venezuela is in full-blown free fall at this point. We've got Brazil in a full-blown, very, very ugly recession/depression. Greece, obviously, a lot of Southern Europe is actually in recession at this point in time. China, I'm not a 6.7% growth kind of guy. I think they're closer to 1 or 2, but what for China, anything below 4 at this point, given their debt loads, is as good as a recession. So, United States, so close to recession, probably in one, probably. But it's hard, if we had an honest accounting for inflation, the U.S. has been in recession continuously since about 2006, 7, somewhere in that zone. We've not ever recovered at this point because I think an honest measure of inflation, which is deducted from headline economic growth, their personal consumption expenditures running at 1.5%. Nobody I talk to is even experiencing anything remotely close to that. We're all experiencing anywhere minimum 4% to as high as 8 or 9%. If you're a elderly person living in San Francisco and you're renting an apartment, you've been experiencing 18 to 19% inflation.
So many people are looking at the market right now, and they're looking at all the economic indicators like GDP, manufacturing, and everything that I mentioned before, and we're seeing everything contract at this point. Do you see something happening this year or maybe next year where everything just comes to a screeching halt?
Yeah. So, Dave, I can't ever analyze anything from one perspective anymore. We know that the political cycle is important. And we know for a fact that right now the establishment is scared to death of having anybody remotely like Bernie Sanders or Donald Trump, some true outsider, somebody with an outsider sort of a mindset, come in. And so the best possible way to assure that there's a so-called, I'm putting air quotes up here, a correct election would be not to have anything bad happen in the economy. So every lever is going to be pulled to try and keep this thing roughly afloat through November. But again, we're just putting Band-Aids on what I think is a bleeding patient at this point, with arterial damage. So this has happened so many times that in my lifetime, I've seen that, election year cycles, for whatever reason, we see extra amounts of stimulus just get chucked into the markets to keep them elevated. Here's my open question. I don't think they're going to, this is my call. I don't think they're going to be able to maintain this even through November. I think we have an ugly moment in front of us. All it's going to take is one little tiny butterfly flap wing event somewhere, and this whole house of cards could come down. People know that. I talk with hedge fund managers who are scared to death. I talk with common people on the street who are very nervous. Anybody who's paying the slightest bit of attention knows that this whole rigged game is really just one vote of no confidence away from having a bad moment.
It's funny. This whole thing reminds me of 2008 when we had Obama and McCain running for election at that time. And, McCain was out there saying the economy's doing fine. And then all of a sudden, going into September, then October, everything completely fell apart. The market crashed. And we had the same scares like in August and September. And we're starting to see the same thing happen once again. We're in the election year. The market is fluctuating, bouncing around. It's dropped at the beginning of this year, and it seems very identical to what happened in 2008. It feels like we're back in the same spot.
Well, it does to me too, yeah. Oh, sorry, keep going.
No, and I was just going to say, you and many other people are saying that the same exact thing, that as we move throughout this year, that it doesn't look like we're going to make it. And all I see from the beginning of 2008 going forward is every time they make a prediction, it seems like the opposite's happening.
Well, absolutely. We've never seen, so for instance, the earnings and the revenue recessions that we're seeing across all major U.S. corporations at this point, the whole basket of them, we've never seen this particular erosion in earnings and revenues outside of the context of a recession. Furthermore, we've never seen the stock market just seemingly power higher while we're getting worse and worse results back from the corporations that are allegedly, supposed to make up the basket of these things. Caterpillar has never experienced the sort of destruction it's seeing to its top line sales revenue. It was never even this bad during the Great Depression, right? So there's a variety of things here that say we should be seeing caution. We should be seeing risk being priced in. It's not, and everybody knows why. The central banks are doing everything they can to keep the stock markets painted. Why? Well, if they have them up, it creates the appearance that everything's okay. So, you're asking me, is it this year? Is it next year? Look, it could be 10 minutes from now, or it could be a year and a half from now. But my message is this: when this puppy gives way, you are not going to have a lot of time to get your preparations in place, because it's going to be frightening, scary, really wild, and who knows if it doesn't end in some kind of shooting war at that point, because the kind of financial damage that's sort of the crumbling of the financial infrastructure is so profound that the world has really never experienced something like this without politicians saying, give me the easy way out, which, by the way, is getting in a war. That's a way to sort of vent and pretend that you don't have to look in the mirror and say, gosh, we kind of did this to ourselves, didn't we? That's where we're at right now. And so whether it's this year or next year, I'm a little agnostic, because I'm very worried about just how ugly it's going to get.
How long do you think it would last? I mean, do you think it's like a 2-3 month thing where, okay, things fell apart, and now we can make it all better and everything is fine? Or do you think this is going to be long lasting?
Well, I think that there's going to be a big deflationary sort of an episode. We'll experience that as a real flight to safety. We're going to experience that as a real destruction in a bunch of financial markets, and that is going to be necessary to experience a good amount of pain for the central banks to begin what you're calling what we're calling Act Two, which is money for Main Street. When they do that, that's still going to take a number of years to play out. But at the end of that, people are going to look back and say, how did anything ever work before? I mean, let's imagine like Zimbabwe. Like, that's like the worst case of monetary printing that most people are aware of in modern history.
Right.
That started in about 1997 and didn't really play out it took 7 or 8 years to really, and it didn't even burn itself out. I mean, the currency became completely worthless and they had to go on and use other currencies, but that was still a multi-year process. So once the central banks begin their printing process and really handing that out, it's going to take time for this all to play out. That's the 80%, 90% probability. I'm still personally, mentally and physically prepared for the 10 to 20% probability, which is that this really gets away from them. And there's so much awkward potential energy in the system that it really snaps and snaps hard. And we see system failure, banking system failure leading to supply chain failure, leading to a lot of bad things that really become very difficult for people to prepare for. And anybody who wants to understand that model, please, it's almost like a news blackout up here. Just Google up Venezuela and read about what's actually happening down there right now. Stores are stripped of food, basic supplies can't be had, drugs are out of the hospital, the morgues are filling up. It's a complete full-blown social disaster at this point in time. That's what happens when your money system breaks.
Chris, what can people do financially in their preps to combat what is coming?
Well, in the book Prosper, we talk about very specific things people can do. Adam Taggart, my co-author on that, and we've spent years both preparing ourselves personally, but working with lots and lots of people, both at our website and in seminars, like the upcoming seminar we've got in Rowe, Massachusetts, coming up starting Thursday this week. People come, we assemble, and we talk about all the different things people can do to prepare. What should I do is the most common question after people sort of get awake and alert and understand the risks in the system. And so we have 8 different areas in Prosper we talk about that people can improve their capital. So financial capital, very big. But we also talk about living capital, which is a garden you might have, your own health, personal health. Material capital could be the solar systems you install or the awesome pieces of equipment you've got. But there are other things like emotional capital and social capital that are a little softer, but just actually some of the most important things that people can work on developing, things that are a little bit tricky to just buy. You kind of have to put the hard work in. They take time. But what we know now is that emotional capital, probably the most important one, because if somebody is rich in 7 other forms of capital, they've got plenty of time, good knowledge, skill base, they live in a great area with good cultural capital, nice house, tricked out, big portfolio. If they fall apart emotionally, mentally, the minute things get a little tough, they freeze, then they're going to do just as badly as anybody else. So these are the kinds of things that we really work on people. Some are very tangible, some are more qualitative. Those 2 big areas are really important to work on. And so here's a key message. Some people will say, but I don't have a lot of money. I can't do this. And the answer is, none are so poor as those who only have money. You can be rich in social capital, in cultural capital, you can be rich in time capital, emotional capital. That's going to make you an incredible asset and have a better life today, but also be more resilient for whatever may come in the future than somebody who just has a lot of stuff and a bunch of money, right? So there's a very hopeful message here. And I'm actually, you're talking to somebody who's prepared, but I don't live with a lot of fear. I live with a lot of joy in my life. I'm healthier than I've been in a long time. And, that adds to my life today. But if we get some of these, crazy futures that are possible, I'll be more resilient and prepared for those than the average person by a long shot. And so that's what's in Prosper, is sort of a model for how to really broadly think about ways that you can really increase your personal resilience. Some money helps and some you can't buy.
Chris, thank you very much for being on the X22 Report Spotlight. I appreciate it. Thank you very much.
Dave, it's been my pleasure.